Now, you also asked me about investments. I saw it in your notes, right? You want to know about that?
Yeah.
Okay. So right now, again, I wouldn't ask you to invest because again, your priority is getting that skill, whether it's in trade school, whether it's in college, or just doing whatever you want to do, right? Investing in yourself is going to be your priority. However, once you start making a decent amount of money, because again, right, real estate is long term.
Yes,
Stocks
as
are
well.
long term, right? When you're doing, for example, index fund investing or value investing, I don't play the game of like I buy today, I sell tomorrow. That's usually speculation and also a lot of gambling. And when you make, for example, $15 an hour and you put at risk $100, that's 6 hours of your time gone down the toilet if you miss. Okay, so I
Hmm.
treasure my time a lot because I know what it is to make not $15 an hour, to make, for example, $8 an hour working a minimum wage job when it was that much, right? So when it comes to investing into stocks, if you're gonna be a full-blown investor like Warren Buffett and read, for example, for 8 hours of your day, great. You can do that. Two books are The Intelligent Investor by Benjamin Graham and Security Analysis by David Dodd and also Benjamin Graham. However, if that sounds boring to you, and it does sound boring to me also, reading for 8 hours a day, shout out to Warren Buffett though, what I do is index fund investing and also ETF investing. So my priority would
ETF?
be, yeah, ETF investing and also index fund investing. ETF is more, for example, when you're doing like a taxable account because you're maxed out, for example, your retirement accounts, or you want to do it, for example, into an account, a brokerage that doesn't really offer index funds. You want to do it, for example, with the ETFs. An ETF can basically also track an index fund at the same time. But the thing is that basically it can be influenced by the market fluctuations at the same time also. While index funds are only basically priced by the net asset value, which is different. It's called the NAV value. But overall, the main priority would be, hey, I want to max out my Roth IRA first. If my company gives me, for example, a match, well, I want to do that because that's basically free money. I get all the free money. Then I max it, for example,
Hmm.
my Roth IRA. Then I grab the rest of the money and I put it, for example, to max out as hard as possible. Now that might be between 10 to 20% of what you actually make. But again, your priority is going to be, hey, I'm investing 10, 20%. I also have
Yeah,
3 to 6 months of emergencies, right? Now, what happens with the rest of the money? You save that money up for a down payment on a home, right? A personal home. Now
yeah.
remember, right? This is not like tomorrow. This is not when you're 20. It's not when you're 21 or 22. It's later on because you might say,
Yeah,
well, I want
yeah.
to live here forever. Then you meet this girl. She's like, I don't want to live here. You know, you're like, okay, I don't want to live here either, right? So it's all about,
Yeah,
it's
yeah.
fine. It's fine to rent because it gives you freedom to see like what you might like or what you might not like. You're not throwing money down the toilet unless you're going to stay there, for example, for like 10, 20 years. That's different, obviously. But you save money for a down payment for a home, 10 to 20%. And when you buy a home, you buy on a 15-year mortgage and make sure the house, the mortgage, taxes, insurance, HOA fee, maintenance, everything included together is no more than 33% of your monthly income. Now, what happens this is, okay, it means that the house you buy that fits this profile according to you and your income is going to be relatively cheap compared to how much money the bank is actually willing to give you. Meaning, once you buy this home, you should have at least 15% extra of your income to throw towards that mortgage extra, which means that you're gonna be done, for example, in 7 to 10 years. Now, the picture is this: 2, 3 years, you have your license or whatever, or you have your
Hmm.
trade skill. Now, 7 years later, you own your home and it's fully paid off while you're also investing 10 to 20% of your income. What does that mean? It means you're 30, 31, you have your own home, you own it, it's yours, you have a lot of money in
Hmm.
investments. And now if you say, hey, you know what, I'm taken care of right now. Now let me see, hey, do I want to do this business? Do I want to do investing into real estate with like rental properties? Great, you can do that, right? But at this point, you can't really get hurt because basically you took care of yourself first. Now that's a long-term plan, and that's what I follow.
Yeah, 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 yeah.
Okay?
Yeah, I got all that. Yes.
But it's gonna be ETFs and also index funds. Or mutual funds if
Yeah,
you're into that
okay.
stuff.
ETF and then index funds. That's I mean, like I have Robinhood right now, but
Mm-hmm.
then I'm gonna look into the ETF and then index funds.
What do you, again, that's like for later. Your priority right now is
Hmm.
like is just, for example, like finding that skill and paying for it in cash when you graduate, or you pay for the skill, you can graduate debt free or whatever. Now, what are you
Okay.
currently investing into in Robinhood?
Right now it is Gush, which is Direction Daily Oil and Gas.
Mm-hmm.
American Airlines, Aurora Cannabis, Marathon Oil.
How much money have you invested so far?
In total, I have $4,500.
$4,500, right? Now,
yes.
Let's say, for example, you lost all that money. That would be 300 hours of your time.
Yeah.
Now, again, I'm not saying don't be a stock picker. You probably did it, like, are doing very good right now because basically the market is ridiculous. Like, you can invest into a rock, you'll make money. But the goal is that if you want to do this full time, you got to learn the language of accounting, which is, it's incredible for a lot of people. For me, it's very boring, and I graduated with an accounting degree, by the way, but I can't stand the subject that much. But if that sounds interesting to you, then great, you could do that. If you want to read statements every day, the 10K forms, the 10Q forms, the balance sheets, the income statements, the cash flow, you want to develop your own target prices, you want to check the PE ratio, you want to make sure that this company is actually going to grow long term with the finance skills you actually develop, then great, right? It's like a full-time job. But if all you're going to do is say, hey, I'm going to pick this company because basically in March, airlines went down, so I think it's going to go up later on. I want to pick Tesla because everybody's investing in Tesla. I want to like pick oil because oil was depressing also during March. Then it sounds like you're making a smart decision, but there's no like real knowledge behind it. It's just like basically like sub-level knowledge, right? You know what I'm saying? You know what I'm saying?
Yeah. I'm not like you're right. I don't have that much knowledge to the stocks. All I know is that it did crash. Like it all went down, and I was just looking at previous how it was. So then it just caught my mind.
Now the hardest thing ever, Huang, is making a speculation or decision that you think you're right on and getting the result that you actually wanted. Now, why is that a bad thing or is very hard to actually stop doing? Because basically, if you invest this way, it leads you to a false level of comfort or to believe that basically you're smarter than you actually are. Because guess what? You're actually making money, right? However, if you really don't know what you did, then it's a problem because although it went up and you know for a fact that maybe I just got lucky here, it might be time to basically liquidate everything and basically, hey, I got lucky here. Let me go ahead and use this money to basically buy my skill or whatever I want to buy, right? However, if you do run into, for example, into a hiccup here and there, and you lose, for example, 25% of your portfolio or 50%, you're gonna panic like a madman. Why? Because you don't know the true value of these companies or these commodities you're investing into. However, if you did know the true value, you would say, hey, I can buy at a discount now. But people say, oh my gosh, buy the dip. And they're like, the dip relative to what? What's the target price? I don't know. I don't know. It's just down today, so I'm gonna buy, right? It's a red day. It's stupid. That's not what you want to do, right? It's kind of like saying, you like sneakers? What do you like?
Yeah, I like sneakers. Yeah, I like sneakers.
Okay, it's kind of like saying, you know what? I'm gonna buy this pair of Jordans. They go for $100, but I'm gonna make I'm gonna make a big bet. I'm gonna pay $150 for them, hoping that they go up. But you have no knowledge. You have no math. You have no history that this is actually going to go up. The only thing you know is basically that maybe last year the other one actually went up, but there is no real fundamental knowledge. You don't really understand Nike, the company, the marketing, the structure, the competition. That's the idea. And by the way, you can get very rich without knowing that stuff by doing, for example, index fund investing, and that's why I do it. Okay?
Okay. Yeah.
But there's no need to rush, brother. You're 19 years old. You got a skill. Once you got the skill, you're good to go. Like the world is your horizon.